Everyone, thanks for joining us both in person and virtually. My name is Ian Shavitz, and I'm the lead in the environmental and renewable energy practices here at Lippis Mathias. We have a great panel today and a great discussion, and I'm going to let them introduce themselves rather than me just reading their bios, but just wanted to cover a couple things at the front end. Before I introduce the panel, I want to first cover why we're here. So earlier this year, we did a presentation on solarizing brownfields and landfills, and really did it at about the 10,000 foot level. And afterwards, I think it was well received. I got a call from Dan Montante from Montante Solar, and he said, "Hey, let's look at this. Let's look at doing another one drill down a little bit, talk about the financial incentives, talk about the benefits, do something that will really drill down on the real reason why solarizing brownfields and landfills is a great thing." And so since Dan Montante and Montante Solar are clients, and the client's always right, here we are doing this presentation. But seriously, I thought it was a good idea, and I reached out to my colleague Marty Doster, and Marty said, what we really need to do this is we need a case study. We need an actual site that we can look at numbers, we can look at the contaminants, we can look at how it was cleaned up to really have people understand, site owners understand what they can do with their solar fields. So we also brought on Steve Phillips from Haley and Aldrich to help us from kind of the cleanup perspective. And we came up with a case study, which those in the room should have in front of you. It looks like this. And also those at home should have, or participating virtually, should have received it via email. Excuse me, and it's also included in the chat. So, what this case study is in the site, and I'm not going to go into it in detail, but it's essentially, it's an 80 acre site, 40 of which had contamination and is going to be utilized for a 6.5 megawatt solar project. We're going to talk through the cleanup of that. We're going to talk through continuing obligations, continuing control measures that DEC put there, and how you could build a solar project around that. The last thing I wanted to cover now is really the timeliness of this presentation. This past August, Congress passed the Inflation Reduction Act, that provided significant incentives. Well, it continued certain incentives and provided other tax incentives to develop renewable energy. The two most relevant provisions for our purposes today is one is tax incentives for developing solar projects in what the Act calls energy communities. And an energy community is defined to include a brownfield. And brownfield, as that term is defined within CERCLA, but what you'll hear today from Marty is brownfields can mean different things for different purposes. The next is, and I really don't like to use the term game changer, but I'm going to here because everything is now a game changer, but this one I think is, and the reason it is it now allows for non-tax-paying entities, municipalities, Indian tribes, not-for-profits, to be able to take advantage of what tax-paying entities could take advantage of, which was the tax credit for developing solar. So in the past, a non-tax-paying entity had to find someone to partner with that could utilize the tax credits and take the tax credits for their benefit. Now, the IRA, the Inflation Reduction Act, allows for a direct pay option. So it's as if you paid in extra and you get a refund check from the IRS. And so that's going to be huge for municipalities and tribes. And we've already heard from a number of our clients, they're now looking at those opportunities. So one last thing, as we move forward, we want this to be a conversation. Please feel free, those in the room, to ask questions, those online to put questions in the chat, and we will go ahead and we will address them as they come up. So with that, let me start the introductions with Dan.
Hi, everyone. My name is Dan Montante. I'm president of Montante Solar. We're located in Buffalo and been around for about 12 years, and very happy to be here today to talk about solarizing brownfields.
Thanks, Dan.
I'm Marty Doster. I'm with Lepus Mathias. Previously, in a different life, I worked for the New York State Department of Environmental Conservation. I was the regional engineer in charge of environmental programs, remediation programs, Superfund, RECRA, SPO program, Brownfield programs, and had a great career there. And I now work with the law firm and assist clients with these environmental issues.
Steve Phillips. I'm with Haley and Aldrich. We're an environmental and engineering consulting firm. I spent my whole career there, dating back to the early 1990s, with a lot of experience in brownfield site investigation, cleanup, and also helping our energy clients get renewable projects permitted and built. So the intersection there, here to provide some perspective. I'm not outside of work. I'm not from Buffalo. I'm not born and raised here, but I will say I'm a lifelong Buffalo Bills fan.
You're accepted.
And since we're in Buffalo, the Buffalo Bills had to come up in the first 10 minutes of any presentation or conversation. Katie?
And I'm Katie Sosha. I'm the business development director at Montante Solar. I've been in the solar industry for about 7 years. First half of that as a project manager, and second half in my career at Montante, kind of putting these complex projects together and figuring out, how to create a solar project out of, a land site.
Great, thanks. So I'd like to get started with Marty, who can kind of set the table with respect to brownfields and who comes at this from both a regulatory perspective and an engineering perspective. So Marty, can you give a brief overview of what a brownfield is from a factual perspective, but then really from a regulatory perspective where different programs define brownfields in different ways?
Sure. So at the base level of brownfield, I think is an accepted term, which kind of means a tainted property. Something that's underutilized. It could be underutilized for a lot of different reasons. It could be a gas station that's out of business, but it's in some way tainted, usually meaning some kind of contamination. And from there, we vary on different programs and what their definitions are. The state's brownfield program, for example, you need to show that there is some contamination indeed there that is preventing reuse. But NYSERDA, or for example, the IRA, the mere presence of the potential to have contamination there, which can come from a phase 1 report indicating that it's past historical use, likely contains something. So a lot of different definitions, a lot of different working definitions. But for our purposes, and the state of New York, NYSERDA confers to the DEC's definition of a brownfield, and that is it's got some contamination above some published guidance values. We know historically that the market is risk averse on development, right? So that's why some of these tainted properties kind of sit around for a long time. A lot of people don't want to invest in those because of that risk. And the risk comes from those environmental laws, those laws that attach liability with any owners and operators of a site that's contaminated. So a little bit of risk there. And so governments, typically state governments, came up with brownfield cleanup programs to overcome that risk and attract development. And they do that primarily, certainly in the state of New York, with tax credits. And that's how they attract developers to those credits, and also the liability release that goes along once the cleanup is done. So two big things there: liability release is a big one, and certainly the tax credits. Recently, those tax credits, the brownfield program in New York State anyway, was just redone and extended, and they made some tweaks to the program. And one of those tweaks is in the renewables. So if you're going to use a brownfield for renewables, you're going to get an extra 5% bump in the tax credits on the tangible side. So we can get into the details later on if there's questions on the tax credits, but essentially it's 2 buckets of credits. One, you get a credit for cleaning up a site, and that can range from 22 to 50% of those cleanup costs, depending on the level of the cleanup. And that's one bucket. And then the second bucket is called the tangible property tax credit. And that's what you build on it after the cleanup, what you put into it, the capitalized costs. And those can range from 10 to 24%. So you start with a base of 10, and if you're doing a renewable, You get the 5 right off the get-go to get you at 15. And there's others as well, and we can get into those if there's questions on that. So why we're here is to kind of talk about a case study of a landfill, because a landfill is a perfect example of where a solar field could be placed. Because it's certainly a brownfield. A landfill is a brownfield. It's contaminated. Otherwise, it wouldn't be covered or capped or gone through remediation. And it's typically in an urbanized area, close to transmission lines and things of that sort. So for a couple of different reasons, this might be a good example, and I'm glad you chose that today to study that. So I'm going to stop there. I'll pause, but I just want to talk to just set the stage on a brownfield, and then I'll interject as we go on.
Yeah, before we move on to Steve with the next item, one thing that I think DEC was trying to do and Congress was trying to do in the Inflation Reduction Act was not only generate renewable energy development, but also to have it developed in the right places. Right, so brownfields, for example, so a situation where you're going to be taking a area that's not productive and using it for a productive purpose. Brownfields also tend to be in environmental justice communities, so communities with high minority populations, low income populations. And then when you look at some of the other tax credits in the IRA, which we're not going to get into in detail, but there's a number of these credits for building solar in places that used to basically have coal mines there, right? So it's these coal mining communities that essentially their main source of revenue is dried up, and is trying to push that development there. So really, it does serve this double purpose of cleaning up sites and having solar built in advantageous locations.
And Ian, do you mind if I just chime in on something real
Please.
quick? Just one thing, a point of clarification. So Marty went over, tax credits as it relates to the BCP. There are other types of tax credits involved. I just want to get a clarification. There's the investment tax credit as well, which we'll kind of go over a little bit. So I just wanted to make sure the audience understood the difference between those two things.
Yeah. Okay, so next, Steve, I'm going to turn to you and ask you to describe in detail a little bit our case study, which I hit at a very high level. So if you can get a bit more granular and also talk about the remediation that's going on, what you need to think about and in terms of continuing obligations, and what a solar developer is going to need to think about when they're looking at the site for a solar purpose.
Sure thing. Thanks, Ian. So the case study information that was prepared and provided covers a site, and as Ian said, it's an 80-acre parcel of real property. It is a remediated site. So in terms of understanding what the current status is, think of it as the remediation. The remedy has been implemented, and they're now in a long-term O&M program. And so the site is contaminated with chlorinated solvents in the groundwater, and it came from an off-site source. So the source of the material wasn't on this property, but it's contaminated and ultimately needed to be controlled from a risk perspective. And so what was selected as a remedy was a series of subsurface groundwater collection trenches. And there's pumping wells in each of the trenches. And as you can see on the kind of the conceptual site plan here, the red rectangles are the subsurface trenches, and each one has a pumping well that recovers groundwater, which is all collected and pumped through conduits off-site off of this property and to a treatment system on an adjacent property. And so the purpose there is to basically control the groundwater plume emanating from off this property and keep it from migrating further off-site. And the site's been in operation for decades at this point. So it's a long-term O&M, operation and maintenance procedure. And so everything you see there needs to be maintained. The yellow dots on the plan here are monitoring wells. So they're just independent groundwater sampling points across the site. And the purpose there is to demonstrate, through samples and water levels that the remedy remains effective. And so from an O&M perspective, the site, just goes on year over year. But there's a cost to that. There's probably a $60,000 to $70,000 per year cost annually to operate, maintain, replace parts, system components for keeping the remediation online. So from a redevelopment standpoint, you know, there are certain things you need to think about. There's no structures on this site otherwise is not developed with any, for any other use. But one of the reasons why a brownfield site like this is really attractive for solar redevelopment is because the solar design can be implemented, you know, in and around some of these structures. The infrastructure all has to remain in place, and access to it needs to remain in place. But as a site use, solar, you know, is a pretty attractive redevelopment option. And so we'll get to the solar concept in a minute, but one of the other things that's worth noting is, so for any of the types of brownfield sites that Marty described, whatever the program might be, usually at the end point, if it's a certificate of completion or a site closure or a RCRA closure, whatever the regulatory framework is, there's going to be some environmental restrictions placed on the property. And they may come in a variety of forms. You know, some examples include restriction of groundwater use, prohibiting groundwater use, vapor intrusion risk assessment. So if you want to build a building over a site that has remaining contamination underground, typically they're going to require some level of assessment to make sure the vapors aren't coming up into the occupied space. Land use restrictions. So if it's zoned an industrial site, it typically will require that it, you know, the future redevelopment use is consistent with that zoning. So from a solar perspective, those types of restrictions are easily complied with. Solar doesn't use groundwater. Solar typically is not going to install habitable occupied structures. And, you know, from a consistency standpoint, you know, the zoning consistency, it can usually be demonstrated that solar is a conforming use. So from any of the typical environmental restrictions, solar is a really good fit. In this instance, we've got an ongoing remediation system. And so really the restriction there is that you need to maintain access and for the ongoing obligation for the remediation. We'll get to that next. The last typical restriction that's put in place or sometimes used as an institutional or engineering control is a cap or a cover system on the site. So if you get done with your cleanup and you've got some residual contamination in the soils, what they may do is they may allow you to cap the site with an impervious surface, pavement, concrete structures, or, you know, clean fill with vegetative cover of some thickness. And so that cap serves as a measure to restrict direct access or direct contact exposure. And typically what's required there is you have to maintain that cap and cover in perpetuity. We'll hear in a little bit that from a solar perspective, there are ways around constraints associated with a cap and cover system. They can be designed. There are the things that can be designed in the solar arrays that avoid, you know, conflict there, whether it's ballasted foundations or instead of doing maybe trenched utility conduits or underground structures, they may be able to place those at the surface in surface conduits. So, you know, again, all of that said, that, you know, from a reuse standpoint of the property, solar, you know, is a really good redevelopment option. And we'll hear also about some of the, you know, the financial models in the coming slides and options from Katie and Dan.
Great, thanks, Steve. So now, kind of Katie, on to you. You're getting your eyes on this, you know, on this brownfield from the solar developer's perspective. You know, what do you see? How are you going to solarize it? What are your concerns? How are you going to get around some of the challenges that Steve identified with respect to ongoing obligations, monitoring, remediation infrastructure?
Yeah, so I mean, I guess I'll first, even before that, address the fact that, you know, the state and federal governments are definitely pushing solar developers into these types of sites. They're incentivizing it. And often, you know, the value of it is so great. It's like, you know, we're actively pursuing them, which is why we're all here today. Usually these sites, from a permitting perspective, you know, people want to see the reuse of these sites. They're usually just kind of left for a while. If it's a landfill, it's often, you know, just like a big hill coming out of nowhere. Like nobody really has use for these things. So from a permitting perspective, it's also often a lot easier to permit on these types of sites. Also, one of the major things that we look at before we can even talk about solar is the interconnection feasibility. Often these sites are located by either transmission lines or three-phase infrastructures. They used to be industrial sites of some kind often. So they really line up from an interconnection feasibility standpoint often with what our goals are on the solar side as well. In regards to constructability, when we have a site that has some environmental easements or restrictions, solar, as Steve mentioned, is a really non-invasive reuse of the land. For this site here, this site does have a cap on it for all intents and purposes. And this system that we're proposing here is a pounded post system, which means we're not actually excavating any of the dirt to put the posts themselves in. We're really just hammering them in the ground. Also on this site in particular, we're going to do an above ground conduit system. So we're not going to be trenching, displacing spoils, needing to have like the same type of environmental monitoring that you would need to do with excavation on sites. So that's another thing we'll often do here. When it comes to a landfill, and we can't do that, you cannot penetrate a landfill cap. There's obviously things that, reason why it's capped and vapors and odors that we wouldn't want to come out of there. What we can do for a landfill cap is do ballasted systems. These are all things that we need to work with the DEC. They often need to look at a landfill closure report and need to see our plan for remediation, as well as the weights of the ballast in the solar system as a whole. So there are definitely a bunch of solutions, but for today, we are talking about a pounded post system. This system also is a tracker system. So it goes from, it follows the sun from east to west, and it gives you about 15% more solar production than a standard fixed tilt system. We're also going to design the system so that we're keeping at least 20 feet away from any of these monitoring wells. That's really dependent on what kind of wells they are and what they're monitoring. For this site, we've kept a 20-foot distance. And one of the other things I want to point out is kind of this black line is a utility trench, which provides power to those monitoring wells. So often we can't build over those areas either in case we ever need to excavate and restore any power to those areas. So often solar is a really practical, non-invasive, lucrative reuse of a brownfield site. And working with the DEC, who does say that solar is one of the only recommended reuses for solar on landfills as well, just really puts us in a really good spot to be able to capitalize on the opportunity here.
Great. Thanks, Katie. And I'm gonna, excuse me, go to the next slide. I guess Katie, you and Dan can talk about, and you started to preview this, the different types of credits. There are the types that Marty was talking about in terms of credits for cleanup of brownfields, and then you have the credits associated with, with actually putting solar down and at the state and federal level. So, we wanted to first give an overview of what these credits are, and then we'll look at how these credits can be utilized in 4 different scenarios with respect to developing the case study site.
Yeah, so I'm just going to run through down the incentives that this project in our case study is going to be getting. So we do have the Brownfield NYSERDA incentive. It's a guaranteed NYSERDA Brownfield adder of 15 cents per watt. We're also going to be getting a prevailing wage adder here. Any project now over 1 megawatt in size is subject to prevailing wage rates in New York State. NYSERDA, for those of you who aren't familiar, it is a program that comes on a first come, first served basis. And so right now, the NYSERDA block that's currently open is NYSERDA block 20. We have assumed that this project is also going to be getting 12 cents from NYSERDA block 20 as well. Along with that, this site is assumed to have 18% BCP tax credits. And then on the federal benefit side, we have our breakdown of our total investment tax credit here. Something new that came out with the IRA is we have an additional 10% for those brownfields or those energy communities. So now our ITC is up to 40% here. And we also have the option for bonus depreciation as well as accelerated New York State depreciation. And then again, direct pay is something that is an option for nonprofits, municipalities, Native nations, et cetera.
Great. Just have a technical issue for one moment. Okay, great, thanks. All right, great, thanks, Katie. So now we're going to talk about the options for owners to leverage their brownfields. We really wanted to highlight for brownfield owners the opportunities they have and the different options that they have. So as you'll hear, there's different advantages and disadvantages and certain circumstances where one option is better than the other. But the four that we're going to look at from a deeper dive from a financial perspective is ownership, where a site owner maintains ownership of the solar project, a land lease, where essentially the owner would lease the land out to a solar developer who would then develop the project, a joint venture where the landowner and the solar developer would jointly own and develop the project, and then a PPA, which is really not necessarily a different type of option, but it's essentially that the landowner could buy the power generated from the solar project. And we see that a lot, especially with municipalities and landfills, where the solar is built on the landfill, it's a municipal landfill, and the municipality goes ahead and purchases the power that's generated from there. So Dan and Katie are going to drill down on the different financial costs, different financial benefits and incentives. Before we do that, I wanted to just introduce one other concept, and that's and you're going to see it on the slides, and that's the concept of ESG, which stands for Environment, Social, and Governance. And it's something that people are hearing more and more about, and it's we could do a whole presentation on it and have, but basically it's what I think about as non-financial standards and values that can have financial implications. So what we have is, that certain investors will only invest in companies that have a strong ESG footprint, meaning that they have they're operating in a sustainable way, that they have governance to protect them from, measures to protect them from such things as climate change, that there's diversity and equity in their, in their ranks. And so, one thing we see is that for a municipality, for a corporate owner of property that, that is looking to do something with a brownfield, it's going to be a net positive from an ESG perspective. You're generating energy from a non-carbon source. Oftentimes, this is in an environmental justice community, so you're helping the community. It's going to bring a tax base in to the communities where you're operating. So there's these benefits as well that may not be necessarily financial, but they do have financial implications and ramifications for a business. And then finally, after we walk through these four options, Dan and Katie are going to talk to you about the opportunity for a feasibility site study. So if we do have any brownfield owners here online or in the room, which I know we do, what this team could do to help you understand and look at the viability of your property from a solar perspective. So with that, let me go to turn it over to Dan, who can talk about the direct ownership model.
Thanks, Ian. So I'm a solar developer. Katie and I are both solar developers, and we typically talk in terms of watts, kilowatts, dollars, or pennies per watt. But it's really important to look at the absolute dollars. So let's kind of turn the chapter to we're going to build a solar project. And we're going to build a 6.5 megawatt solar project. And the cost of that project is about $11 million. It's a fair assumption. The cash incentives, and notably, these are all from New York State. So these are state incentives, and we'll start with NYSERDA. For a project like this, NYSERDA will pay a base incentive about $1.5 million. And to that, they will add an additional $975,000 because the site is a brownfield. That's I think a very rich incentive from NYSERDA. But then you go over to the brownfield cleanup program, and the DEC will provide almost an additional $2 million of refundable tax credits to the owners of the system. So in aggregate, you're going to generate about $4.5 million of incentives, cash incentives on an $11 million project. Let's flip the page to the next level of government, and that's the federal side of things. And the richness of the Inflation Reduction Act cannot be overstated. The project we're talking about would earn a 40% tax credit. So 40% of $11 million equates to about $4.4 million. You add up your tax credits plus your cash incentive, and you're generating almost $9 million of funds for the purpose of building out this project. It leaves about a $2 million gap. And then you get into the reality of what a solar project does. It generates electricity. That power project will generate about $935,000 a year of power value. And because of that, you're going to earn and recognize a payback period of really about 2.5 to 3 years. And this is ignoring depreciation because these assets are also eligible for bonus depreciation. And for the sake of this presentation, we just kind of ignored it, but it's like the cherry on top. Really a terrific project. And if you're a corporate in particular, and really are tracking your ESG goals, you have some pretty big numbers to brag about. Number one, you're going to be procuring over 10,000 megawatt hours a year of clean renewable energy. And then on top of that, you're going to be saving the environment about 7,400 metric tons a year by using a non-carbon source power generation. So pretty compelling. One thing I just wanted to remind everyone on the federal side, for municipally owned sites or project sites that are owned by a not-for-profit or a non-tax paying entity, they are potentially eligible for direct pay. So instead of a tax credit, that would be a direct cash payment. So a lot of little goodies in the Inflation Reduction Act. And admittedly, some of the benefits are still being digested and understood. But on the face of it, the incentives and tax credits available for solar projects are pretty remarkable today.
And can I weigh in one more thing on the ESG aspect of that? So, both on the public and the private side, there really has been an acceleration of attention to ESG goals and metrics. We're seeing a lot of that across all of the markets in our private client base. And you're probably seeing it in the news as well. And so, most organizations at this point have established ESG goals or are on the way towards doing so. So, in addition to maybe the financial incentives and benefits of a project like this, there's also the credit that can be claimed toward their metrics and reporting on their annual or 3 or 5 year ESG goals, including offsets of CO2 emissions or power production. And so that shouldn't be discounted. Again, that's kind of a cherry on top benefit, I think. But then the other aspect of this, if you're doing it on if you're building this on a greenfield site, that's one thing. But if you're doing it on a brownfield site, you're now also either cleaning up or finishing a remediation for an environmentally impaired property. From an ESG reporting perspective, you're taking what maybe is an environmental liability that you own and turning it into an asset. So I think there's a lot of maybe intangible value in addition to the this purely the financial picture.
Yeah. Let me add one more item here. So we're going to be talking about 4 different options. The first is direct ownership, and this might go without saying, I'm going to say it. In terms of which option provides the best long-term value, it's the purchase option. It truly is. We're all faced with the question: you want to lease or buy your car, and we're all tempted to lease. But if you really think about it, the best long-term value is to buy. So to the extent you are in a position that has the capital and the ability to absorb tax credits, this is a great way of really maximizing project value. You're maximizing your cash incentives. You're maximizing the amount of energy and the value of the energy that the project is deriving, and you're creating a pretty massive tax shelter along the way.
We had a question in the.
Just for clarification, this was the development of the 40 acres out of the 80 acre site.
Yes, correct.
And I want to just add one other thing on the ESG front, because I think it is important. As ESG is becoming more important, especially is becoming the pressures to have an ESG program and plan and strong footprint is really most at this point on large public companies. So, the question becomes, well, what if I'm just a smaller company, I'm private, why do I care? Well, you care for a lot of reasons, but one of the direct reasons that you may care that is going to essentially hit your bottom line is that a lot of these larger public corporations that are, that have ESG pressures, they're taking the position that their suppliers have to have a strong ESG plan, their vendors, their service providers. So suddenly, if you're manufacturing widgets, the company that's going to be buying them is going to say, what's your ESG footprint? Because part of our plan is to make sure that our suppliers have that strong footprint. So it's intangible, but it is also tangible. And so going on to the next ownership option, and that is leasing your land. And this is the kind of the easiest one, so that's why I'm covering it, because I can't get steeped in the financials. But basically, entering into a long-term lease with a project developer. There's some clear advantages for property owners there. It's reliable long-term cash flow. There's no development risk. You're reactivating idle land that probably is not income producing, really for maybe any other purpose. And the economics can be strong, as you can see from here, that at a 40-acre site, $1,800 per acre per year, escalating at 2% annually, you're looking at $72,000 for year one. You're up to $2.3 million at the end of a 25-year lease, and then there could be multiple extensions on that. So, it's lower risk. You see, as Dan pointed out, that there's, that the owning it option is going to be is better financially, but, the lower risk, the easier is just leasing it out. So now on to the next option. This is a joint venture. And again, I'll turn back to, I think Katie, you were going to cover this.
Yeah, and so I know that we're going over a lot of information today too, with like the different kinds of options, and obviously different property, different owner, different, option is going to be right for you. So there is a matrix that we put in for you guys, so you can see the pros and cons of each, and kind of, our summation of, which is the best for you given your situation. But going on to a joint venture, so this is a lot like the ownership option, except there is a lot less cash outlay from the person or entity who would partner with Montante Solar. In this example, we would be jointly developing a project on the landowner's land. The cost for the total development of the project is $450,000. And a 25% partnership in that would require a cash outlay of about $112,500. The process would be, once we jointly develop this project together, to market and sell the project. In this scenario, the landowner would also maintain all of the rights to their BCP credits, so their tangible tax credits as well. So that's something the developer would not, Montante would not even touch, completely goes to the landowner. With the BCP tax credits, along with selling this project, we would be looking at a 25% joint venture, which would give us the land to do the project and the cash outlay of $112,500. At the end of the 25-year lease, and after the project is sold, the total value to the entity would be about $2.377 million. So again, this is a little bit more risk than just leasing your land. Much less risk than owning the project outright, and still have the opportunity to maintain those valuable BCP credits directly for the landowner, in addition to getting a portion of the sale of the project as well.
Think about this option. You have, like, if you're in a joint venture, a joint development agreement, from a cash flow perspective, you are going to cash out as the system comes online, and there's a big pay at that moment. And then you have a nice annuity in terms of a ground lease for the next 25 years or more. So it's actually a very attractive option. Maybe it could be for municipalities, but probably more applicable for private landowners. But it's a pretty unique offering overall.
Great, thanks, Dan. And now we're going to go on to the final the final scenario or kind of an overlay of the scenarios, maybe I would say, and that's a power purchase agreement. But Dan, I think you were going to cover that.
Yeah, power purchase agreements. These are pretty typical in our industry. And in short, what a power purchase agreement is, it's basically where you have a developer that develops and owns and operates a solar project. And then you have a single off-taker typically that's obligated to buy the power on a long-term basis at a fixed rate for typically a 20 to 25-year period. A project approach of this nature, a power purchase agreement, likely is very applicable for municipalities or any industrial company that kind of wants to keep a solar project investment off their balance sheet. So there are two sources of value from a PPA. Number one, you're going to generate revenue via your ground lease. And our basic assumption is you're leasing your property, $1,800 an acre. That escalates on an annual basis for 25 years. But the real magic also comes from the savings you're going to derive from the PPA. The way we will structure a PPA is in that basically you generate solar electricity that generates a bill credit, and the PPA off-taker would buy that bill credit for something less than its face value. So instant arbitrage, and that savings would commence on day one. So a lot of great benefits. It's a very low risk way. It's probably the least risky way to enter into a solar project. And the financial benefits are still pretty substantial at about $5.3 million over a 25-year period.
Great, thanks, Dan. I'm gonna, before I go to the next slide, we have a question that came in via the chat. It's our Kiwanis Club owns property that's heavily contaminated with oil. Do we have to clean it up before a solar farm can be placed on it? So I'm going to start with Marty, kind of your thoughts on, can that actually, can we do that? And then I'd like to hear from, and Steve as well, then I'd like to hear from Dan and Katie as to, as a developer, what are your thoughts about that? And I'll throw some kind of legal risk aspect in the end. So Marty, why don't you start?
So if I understand the scenario, they own the property that has oil contamination. That's a brownfield. It's the definition of brownfield. They could enter the brownfield cleanup program and begin the assessment of that property. Meanwhile, they would engage with this team to start looking at the feasibility of developing solar post remediation. But the engineers first got to get their arms around what the problem is and the kind of remediation that would be there.
Well, I think the question actually is, do we have to remediate? So
yeah. Oh, really? Well,
that's the question. Do they have to remediate?
Well, because you use the term oil, oil falls into a certain subset in New York State where it is managed a little differently. Not only do you have to report that contamination within 2 hours of finding it, but yes, you would have to remediate that in some fashion. So absolutely, they would have to remediate it. And their choices are, is they can do that voluntarily, not get into a brownfield program, just do it on their own, work with the DEC and get a simple letter saying, thank you very much for cleaning up your mess. Or they could go into the brownfield program, which is a little bit more effort from their side to do that. But you can see from this demonstration, the benefits certainly outweigh any of the extra.
But what if the contamination was, was metals or chlorinated solvents, something that's not oil, where you don't necessarily have to report it, upon discovery?
Sure. So if you have contamination that's not reportable like that, really that boils down to what's that doing to your property, I would think. So, I take my engineer hat off and put a development hat on. If I'm sitting on property that is tainted, again, we're now dealing with people that are risk averse. Why would they want to purchase your property? So that's kind of a business decision. I would.
Well, they is sitting right next to you.
That's right.
Dan, what's your thoughts? You have a contaminated piece of property that someone wants to potentially solarize.
It's a really good question. And I guess the way I would think about it is we would run a couple of different scenarios. The baseline scenario would be no cleanup, where we just build a solar project on top. And, we could very accurately estimate what the state incentives would be. We know there wouldn't be a brownfield cleanup tax credit associated with that, but where there may be additional benefits versus a plain vanilla or greenfield site is that the 40% tax credit may still apply We are waiting for guidance from Treasury and the IRS and how those situations would be treated as to whether or not you have to actually do the cleanup. But we would run a couple of different scenarios. So for comparison, if it was Kiwanis and they had a clean site, they're looking at a payback period for a solar project in the neighborhood of 4 or 5 years tops. If the project site is eligible for these special benefits associated with brownfield sites, that payback period rapidly shrinks and you compress it down to like 2.5 years. So if we would run a couple of different scenarios, work with Marty to kind of sort out what the options are. Haley and Aldrich can provide estimates of what cleanup costs are, because it's something else we'd like to model is to understand, if it's a minor cleanup, the cleanup effort very well may be worth the cost. Because the value of the brownfield tax credits and NYSERDA brownfield adder are significant. So one of the other scenarios we would compare it to is, let's clean this thing up.
And I'll add from a legal perspective, if it's let's say it's a land lease situation, I'm going to make sure that, my client's the developer, that they're in their lease, they are not taking on any of that liability in terms of for pre-existing contamination. Maybe easier said than done, because even with that type of a legal protection, the other thing that Dan and Katie are going to need to do is they're going to need to figure out how to build this project without disturbing or spreading that contamination. Because even, it's basically, you can usually have a landowner retain liability for pre-existing contamination unless you are responsible for spreading it or you are responsible for, kind of adding to it. And then you get into the economics of, okay, well, how much does it cost to develop? What are going to be the restrictions and what are the economic, ramifications of those?
Sure. Steel plants are a great example. Old steel plants, if you got one, they're great examples how they can be remediated. So just down the road here, the old Bethlehem steel plant, hundreds and hundreds of acres, 600 acres of steel plant. And a lot of that went through the Brownfield program. And some of that is now solar there as well. So good opportunities. Again, they had oil contamination, they had heavy metals, things like that, took advantage of these programs prior to these enhancements. So it was in the old days. 5 years ago.
And if you don't mind, I'm just gonna
Please.
add one other thing. So just because I know we have regular brick and mortar developers in the audience as well. So when you guys think of a brownfield cleanup program, you guys are often doing like a lot of excavation, maybe for foundations, things like that. It's not the same type of excavation or even construction process that we use in the solar industry. So the level of cleanup that you guys are used to seeing might not necessarily be the level of cleanup required for a solar site. So that's just something I wanted to throw that out as well.
Yeah, you want to talk about different levels of cleanup.
Yeah, and sure. So Katie touches on a simple but very complex tax situation in the Brownfield program. Here's the kicker. I said there's 2 buckets of tax credits. So the first one is the cleanup, and so if you do zero cleanup, okay, $0 in cleanup, the tangible property, which is the stuff you're going to build on that, is you're allowed up to 3 times your costs of cleanup. So if you have zero cleanup, 3 times 0 is 0. So you get 0 on your tangible. So it's a little bit of a interesting mix of accounting and engineering, working with Steve and some accountants and Dan and Katie and figuring out what's the best mix to maximize our credits, but also do what's right for the environment and be protective. And that's the trick. That is the trick, to walk away from this with something that benefits everyone.
I think what Katie was maybe getting to, Marty, and maybe you could address with respect to the Brownfield program is, what the different level of cleanup if you're going to build a home versus if you're going to build solar, which is not going to have an indoor structure, you're not going to be dealing with vapor. So how is it a lighter lift under the program, if you will?
Right, it is. So if we were going to build homes on a contaminated piece of property, and I'll use lead as an example, that's lead contamination. The number to clean up is 400. And you can't just put a simple cover system, plant some grass and build a home on it. That would not be acceptable in the program. because it's not protected for a residential scenario. If you were gonna build a hotel or a condominium, that's a little bit different, and you could do what's called a commercial level of cleanup. So for that same contaminant lead, instead of 400, now you don't have to, you can meet 1,000. So it's a higher number, and it's all based on risk. In a condo situation or a hotel situation, people aren't going in the backyard in their swimming pool and playing with the kids, right? It's a different risk scenario. That's how these are calculated. And of course, you have an industrial level cleanup, which this could fall into, and that would be 3,300 parts per million lead. So I just use the lead as an example. You can see how it's a sliding scale on the cleanup. And every cleanup level has an associated tax credit with it. So for that base level, industrial level cleanup, 22% you may get for that credit for your cleanup. But if you cleaned up and removed all the contamination and built homes there and you had unfettered use of that property, you get 50% of your money back on the cleanup. So again, a sliding scale according to the cleanup you do. And the cleanup you do is up to you to decide. Again, that gets into that little bit of analysis, spreadsheet analysis of what's best.
Great, thanks, Patty.
Does any of the cleanup costs get rolled into the base for the ITC? Or is it separate?
It would be considered separate. It wouldn't be part of the basis of the project expense. So it would, the cleanup cost, however, does establish the max limit of tangible tax credits you can utilize on that site.
In the example that you put on there, that was 11 million for a 2.5-year payback on a 6.5 megawatt system. Is that assuming cleanup costs? Or that's assuming cleanup happened?
That's assuming the cleanup had already happened. Like this is like the example that we have here. The site's clean or it's been remediated.
Yeah.
So the representative financials show that.
Thank you.
So before we kind of walk out, one thing that we wanted to talk about is, if you are a brownfield owner, kind of how can you figure out whether your site is viable, from a financial perspective, a cleanup perspective, et cetera, for any of these tax advantages. So really, I'm going to ask Dan to talk about, what we can do as a team with the legal, with the engineering, and with the development experience and expertise to answer that question.
Yeah, so I think the question that came from Kiwanis is a great way to kind of tee this up. It's a pretty basic and innocuous question. We have a site, we think it's dirty. Is it eligible for a solar project, or do we need to clean it up? That's the type of thing we'd love to get our arms wrapped around. And the team up here, sitting up here with me today, could very quickly turn around a couple different concepts. We'd start by looking at, well, does solar work on the site at all? Is it near 3-phase power? Is there capacity on those circuits to interconnect? What's the site physically look like? What's the topography? Is it in a wetland? All those things that you look at with any site, we would evaluate that. We'd work with Steve and Marty on looking at the environmental aspect. I'm sure Kiwanis might have some studies already. Maybe they've done a phase 1 as part of some financing they did. And we could delve into what the various worst case, best case scenarios would be, and get pretty specific around what we think the resulting financial impacts would be. The legal aspect of it is super critical. That would be relevant from a perspective of indemnifying either the landowner or the developer around what the environmental risks are. But the Kiwanis question is the perfect example, because I would envision the output being, well, here's the 2 or 3 different ways you could approach this project. Kiwanis, I would kind of assume they don't have super deep pockets and would want to put a project like that in their balance sheet. We'd propose a different mode of ownership or usage. I think we could put together some pretty interesting options for an organization like Kiwanis, like we could for any, every site's going to be different, and the options are going to be very specific to that site.
That's a really good point, Dan. And from an engineering and environmental perspective, each site is unique. So an environmentally contaminated site, each of them have their own site-specific challenges, and so we'd want to provide some guidance to you as far as what the current environmental constraints might be associated with that, and do that as part of the desktop exercise. You know, what are the contaminants? Are there restrictions in place that you need to work around? What are the other environmental aspects that you mentioned, wetlands, you know, streams, you know, habitat, all those things to consider from a land use and a permitting standpoint. How might you, you know, permit and construct the facility?
And then I think, you know, lastly too, there are a lot of different ways that you can participate, you know, in a solar project. So I think working with our team and us kind of advising on which makes the best sense for you, ownership, land lease, joint venture, PPA, that's something that our team can kind of step in and advise on once we understand your goals.
So if, you know, if we can help anyone, please, you know, feel free to, you know, Katie is the contact for the team and can, you know, can start that ball rolling. Well, we are at 3:59, so oddly, oh, actually, we're now at 4 o'clock. So thanks everyone for participating in the room. Thanks everyone online, and you know, hope this was informative. Thanks. Thank you.
Stick around for happy hour.
That's right. Just beer and wine.
Oh, yeah.
I know. I know.
You got a-